Welcome back. Hello, I'm Tony Keller sitting in for Howard Green. Well, Canada's main stock index is trading at its highest level since last February. In midday trading, there you see it is up by 0.33% in midday trading, though the U.S. markets are closed today because of the Martin Luther King holiday. The S&P 500 closed on Friday at its highest level since December 2007. So what does this say about how investors are viewing equities today compared to other asset classes such as commodities, government bonds, and other forms of debt? And even among equities, are there some sectors that are hotter than others? To discuss, we're joined by three hedge fund managers for our monthly panel on investing strategy. From the hedgy side of the street, my guests today are Barry Allen. He's President and Chief Investing Officer at Mayer Asset Management. Jean-François Tardif, President and Portfolio Manager at Timolo Investment Management, Inc. And Frank Mayer, Chairman and Co-Portfolio Manager at Vision Capital Corporation. Gentlemen, welcome to all of you. Very good to have you here. I want to start by asking kind of a big picture question. When we say hedge fund, what do we mean? Is there a simple definition, or is hedge fund really any possible series of management strategies? Jean-François?
Yeah, exactly what she said. It's like mutual fund. Mutual fund, you can have technology-only stocks. You can have biotech. You can be Canadian, U.S., Europe. So hedge funds is the same thing. You have so many different strategies that I don't think people should mix up the word hedge fund and say this is one style of investing, and it's many styles.
Frank?
I think the common element is probably that there is some paired trading going on, perhaps some shorting, but it'll vary significantly from one manager to the other.
Barry, what do you think?
I don't think there is such a thing as a generic hedge fund, but I think there is definitions of which funds actually deploy hedge strategies and which have other strategies that may be alternative but don't involve hedge funds.
I want to ask all of you, I mean, you're all focused in different areas, you're all using different strategies. Nevertheless, everybody has to think about the big picture, the big macro picture. So I want to ask you, what's your sense of where the global economy is going? Will we be in better economic shape at the end of 2013 than we are right now at the beginning of 2013? I'll start with you, Jean-François.
Well, I don't think so. I mean, the problems, to start with Europe, I'm very bearish in Europe. The problems are far from being resolved. Right now, everybody's calm. That's fine. But the results are not resolved. The debt is increasing in most European countries still today. U.S., I think that U.S. there are a couple of very positive things going on, but overall the deficit is massive. Again, that's in the long term, it will put a cap on GDP growth. And other countries like Canada, I'm overall not very bullish on commodities. I mean, I'm kind of bearish, so I'm not necessarily positive on those countries going forward.
Frank, as we were just mentioning off the top of the show, equity markets have been feeling a high degree of confidence. How do you feel about where the underlying economy is going over the next 12 months?
I don't mean to pour cold water on some of the concerns just expressed by Jean-François, but we're looking at positive things that are happening. The monetary policies around the world are open, full throttle. They're driving down interest rates. Credit is readily available, and it's starting to get the American Federal Reserve is starting to have some traction in the housing sector. We think that the economies are going to be marginally better at the end of this year than they were at the beginning of the year, and we think the outlook for securities is positive.
Barry, where do you come down? I feel like every time you and I have spoken on TV, we've usually been talking about Europe over the last 16, 18 months. Where do you come down on what Jean-François just said about Europe appearing to be somewhat better than it really is?
I'm actually more constructive on Europe than JF is. There's no question that the situation is not good, and I don't think it's getting necessarily better, but I think it's a process. And I think that Europe has put a number of things in place that will lead to better things down the road. Maybe not so much this year. But the most important thing for Europe is I think that the systemic risk for world markets as related to the European crisis is broadly past us. The same can't be said of the United States at all, where truly, as Frank said, that things are fundamentally looking a little bit better, and the housing market is. I don't actually share the view that the housing market is necessarily better, because if I look at who's buying all the houses, their investment funds are buying houses to rent them. There's no real buyers of houses in the United States. It's all capital. And the capital is buying houses in the United States because the Fed is forcing everybody to buy something else other than what they traditionally might own. So I'm actually pretty constructive on markets this year. But the reasons I'm constructive on them are not economically based. They're more technical, related on what central banks are doing. The central banks are all in, and they have no choice but to continue to stimulate dramatically, because if they stopped, I think all hell would break loose. And eventually we're going to get to some of the things JF is talking about. And I think the biggest risk is going to be the U.S., but it's probably not this year.
What's the risk in the U.S.?
The risk is the U.S. Treasury market goes the way of every other government bond market in the world, in countries that have more than 100% debt to GDP, that solvency becomes a component to U.S. government bond yields, not just inflation and economic activity. And we've seen it in every country in Europe that got in trouble. And I would also say that France is a country that is very susceptible to a sovereign debt, some form of sovereign debt crisis in the next 12, 18 months.
JF, how do you feel about that? That thing, sentiment in the U.S., which now has driven bond yields to essentially their lowest levels ever, that turns, and not in a good way?
Well, it's always possible, and in fact, someday it might do that. But look, in Japan, they have 200-something debt, and the interest rates are lower. I'm in the view that interest rates are going to stay way longer and way lower than most people think. I said that many years ago. I still say the same thing. Just because GDP growth won't be as high as it was in the past. I mean, the deficit is roughly 8% in U.S., and this is a massive push down on long-term GDP in U.S. So when you said before, what's the biggest risk? I mean, the risk is how do we deal in the U.S. with this massive deficit? I mean, the political parties still have a problem, even after those 4 years. They still have a problem to just agree on one thing. So we have probably many years of debate between Republican and Democrats on that big issue.
Frank, I want to ask about something that Barry was just mentioning, the sense that the U.S. housing recovery may be somewhat illusory, or we're getting a little bit ahead of ourselves. This is where the financial crisis started. How do you feel about that?
I think Barry is partly right. I mean, there's no question that there's a lot of demand by newly formed companies and real estate investment trusts that are buying housing for rental purposes. However, there are also people who are taking advantage of the depression in real estate prices in the United States and low interest rates to buy the homes that they want. And I think demand is coming back, aided and augmented by people like Canadians and South Americans who are coming in and buying in certain markets. There is a broader-based recovery than I think Barry believes.
All right, we are going to take a quick break. Stay right there. We're going to get some picks from our hedge fund panelists when we return after this break. All right, we're back with our hedge fund panelists. Barry Allen, President and Chief Investing Officer at Mayer Asset Management. Jean-François Tardif, President and Portfolio Manager at Timelo Investment Management. And Frank Mayer, Chairman and Co-Portfolio Manager at Vision Capital Corporation. Okay, I want to ask you guys, we were talking about U.S. real estate. I now want to get into one sector that has been extremely hot in Canada. I'm talking about real estate investment trusts. We've seen them to be extremely successful investments over the last few years for retail investors. And now we've seen this tremendous flurry of activity of mergers, consolidations. I'll start with you, Frank. Are REITs still a good place to put your money in Canada, or is this market getting kind of frothy?
I think the takeover battle for Primaris is instructive. Before it, the average analyst on Bay Street was saying that the full value, the NAV, net asset value, was $24. Well, H&R is now up at $27.33, so it's a 14% above that, which indicates to me, at least, that the analysts are being a bit conservative. That suggests to me that there is further room to go in Canadian real estate investment trusts and real estate operating companies.
JF, what do you think about the Canadian REIT sector? Too many investors piling into an income-generating area because, as you've talked about, slow growth, slow interest rates?
Yeah, no, I mean, I like the REITs. I don't love them, but I like them. A lot of people say, oh, they're so expensive. But, you know, you have to look at the relationship with the long-term interest rates. In 2007, for example, the spread was a lot lower than it is now. The cap rates are about the same. But, you know, you have to keep in mind that the long-term interest rates have dropped significantly. So versus that, there is a cushion on REITs. And that's why I like them. As I said, I don't love them. So the easy money is behind us. So maybe now it's a little bit more in a market where you got to stock pick, you know, the right ones and avoid the other ones. But we own some REITs, and I'm comfortable with the names that we have.
And is your generally positive view partly based or mostly based on the fact that, as you say, you're expecting relatively slow economic growth and relatively low interest rates? If that thesis changed, would REITs then look overpriced?
Yeah, I mean, definitely have myself the view that interest rates are going to stay low. If somebody was convinced that interest rates were going to skyrocket, you don't want to own them, that's for sure. But, you know, for example, some of the apartment REITs, I mean, they have 3% price increase every year. Plus, you know, they give you let's say a 5%, you know, cap rate. So that's 8-9% return per year. You know, that's pretty good in my mind these days. I'm pretty sure that most people that do close to 10% a year for the next 5 years will be the average.
Barry, how do you feel about real estate in Canada?
I'm a little more cautious on it, although I'm not real negative on the REITs. You know, at the core, it's a leverage cyclical business that's very susceptible to rising interest rates, and we're at the lowest interest rates in history. So you can't be really bullish on them, but, you know, a little bit like JF, I'm not real negative on them because I also don't think that you're going to see, you know, increasing rates anytime soon, although I do think that we're susceptible to maybe a spike in longer-term rates, a temporary one, similar to what we've seen in Europe. But you know, I think the quality of Canadian real estate is high relative to other places. The valuations are not, you know, crazy, but they're not cheap either. And you know, and I think that there are REITs out there that are, you know, you can own at these levels. But if you get to the point where rates are going to start rising, these things can go down a material amount.
And Barry, I want to move from REITs, an interest rate sensitive sector, to kind of the ultimate interest rate sensitive sector, fixed income. A number of months ago, we had Warren Buffett saying this could be the most dangerous area to be in because rates have gone so low. How do you feel about that? Is it possible to still make money in fixed income, or are we in for a sudden turn?
I think you can make money on fixed income, but on a relative value basis, and that's, you know, where you come to hedge strategies, where I still think that high yield spreads are going to go tighter this year, and I think very, very high quality credit spreads are very cheap. You know, if you look at companies like Procter & Gamble and Johnson & Johnson and McDonald's, the spreads on their bonds, you know, 75, 80 basis points relative to the U.S. government, I think that they, you know, the quality of the credits of those balance sheets are so much better than the U.S. government. And if we do get into, you know, some loss of faith in the U.S. or solvency of the U.S. thing, you're going to see those credit spreads go materially negative as the world searches for true AAA balance sheets, not government ones that they, you know, in our view, the U.S. government's a BBB credit. The rating agencies are just equally as incompetent on one way as they are on the other. And so I think that that's a great hedge against problems that the U.S. may face. But in terms of, you know, trying to make money in fixed income from declining interest rates, it's it's over.
JF, how do you feel about that? Again, with your view that the economy will be relatively slow growth, interest rates stay low for a long time, still opportunities in fixed income?
Well, I have investment in some bonds, but the sector in the bond market I like the most is the convertible one, because you have less risk than equity, obviously, but you still have some upside. So I don't buy them all, but when I find a convertible bond and it's priced well in an equity that I think there's a possibility for the stock to move substantially, then I'm very comfortable with those. So convertible bonds, that's the place where I see a lot of opportunities.
All right, Frank, thoughts on fixed income?
We are primarily a real estate focused fund, so we're not involved in fixed income, except that the real estate companies and real estate investment trusts do borrow money, and of course they're recognizing and taking advantage of historically low mortgage rates.
All right,
and that's to their advantage.
Exactly. Okay, we're going to take a quick break. When we come back, we're going to get some picks from our hedge fund panelists. We'll be right back. We are back with our hedge fund panelists, Barry Allen, President and Chief Investing Officer at Merit Asset Management, JF Tardif, President and Portfolio Manager at Timolo Investment Management, and Frank Mayer, he's Chairman and Co-Portfolio Manager at Vision Capital Corporation. Okay, let's go through some picks. Frank, I'll start with you. A number of different REITs that you like. One we want to talk about is Morguard. What's the positive story there?
Let me generalize for a moment. There are two enterprises that we like the best. Morguard Corporation and Main Street Equity Corporation. They're both corporations, they're not REITs. Morguard pays a small dividend, Main Street pays no dividend. The characteristic of both these enterprises is that they reinvest their money. And when they do that, they buy additional properties, which raises their top line, and they buy back their own shares, which reduces the number of shares they're dividing by. The net result for these enterprises has been that they've been growing their net asset value at 20% a year over the last decade, and their share prices followed along suit. These are hidden values on the TSX. Today, Morguard is trading at around 120. Its real net asset value, according to the company's financial statements, is around 172. We believe it's closer to 200. It's way undervalued. Similarly, Main Street, which is trading at 32.5 or 33, we believe its net asset value is comfortably in excess of $40 and will ultimately arrive there. So there are still, notwithstanding the popularity of the real estate group, there are still outstanding values out there.
Now, you mentioned both of these companies, and they're not paying dividends.
Significant dividends.
Right. Generally, what people buy REITs for is that income stream. Do you expect these companies to begin paying out at some point? Do you want that to happen?
As long as they can earn more by buying additional properties or by buying back their own shares, we want them to keep on doing what's good for shareholders. And the formula has been highly successful, and both these enterprises, the shares of both these enterprises have way outperformed their peers. So keep the good times coming.
And I have to ask you about the proposed H&R REIT takeover of Primaris. If I'm a shareholder of it, which group of shareholders should be happy about this deal? Potentially.
I think both enterprises are winners. The Primaris unit holders, because they're getting a record high price. The H&R shareholders, because they're getting diversification and additional growth. Everybody's a winner, and of course, as I mentioned earlier, it highlights the value that a lot of other people have not heretofore recognized. These companies and REITs are worth more than people think they are.
All right, we'll move on to JF. JF, I'm looking through. You got a number of different things that we could talk about. I actually want to start with the one that you describe as boring but stable, Enbridge preferred shares. Why would you want to own Enbridge preferred shares?
Yeah, well, there's something going on in the Enbridge preferred shares. They issue a lot of them very often, at least in the last year. And every time they issue a new one, they price it about 50 cents lower than where all the others are trading. So the way I look at those is I buy it when they go back to wherever the others trades at, and that gives you a 2% plus dividend return. If it happened over 2 months, all of a sudden that's a 10% plus annualized rate of return. So those are the kind of the strategy here, that some of the strategy that I use. So and also Enbridge are kind of, the preferred shares are a little bit cheaper than some others, but because they keep issuing some, the market are not willing to pay as much as as they would otherwise.
And
so.
interesting, we were just showing the stock chart of Enbridge itself, not of one of the Enbridge preferred shares. Do you like Enbridge itself, or would you prefer the preferred shares to the common?
The preferred, the regular shares are too expensive for me. They're like something 40 times earnings. Right. I still care about earnings. A great company. They said they're going to grow their earnings 10% per year for many years to come. Almost, they didn't guarantee it, but almost close to guaranteeing it. Yeah, so myself, I'm comfortable with the preferred shares, but this is not necessarily something that we own forever. This is more like for us, we like to buy the new Enbridge when they come out, the new Enbridge preferred shares, and then eventually we sell them in the market when they're trading in line with the others. Okay,
and briefly, I want to ask you about Badger Daylight. This is one that has done well, and you think it may be kind of at the end of its positive run?
Not the long term. Short term, it has had a 30% run in a few months. You know, we bought this position in the latest issue they've done at $25. The stock went down to $22, $23. We bought more, and then it had a fabulous move since then. So in the 30s, we reduced that position, but we still own it. I mean, this company is growing at 20% a year. They have a return on equity of 20% plus a year, lots of free cash flow, a nice dividend. I expect actually the dividend to keep going up in the years to come. So this is something that I hope would actually go down a little bit so I can buy more again.
Okay, Barry, we'll come to you. We were talking about some specific fixed income vehicles that you liked, some high quality credits, McDonald, Procter & Gamble, Johnson & Johnson. Any Canadian corporate credits right now that you particularly like?
Yeah, first I want to clarify that those particular situations, you can only buy those long-term bonds hedged against short positions in U.S. Treasuries. So we're playing the spread there. Because if you
expecting the spread to narrow.
And but on an outright basis, I like some of the bonds in Canada in the resource sector, and mainly because of valuation. One example is Thompson Creek Minerals. They have a bond outstanding, matures in 2017, and yields about 6 3/4%. The high yield market itself has a yield about 5 3/4%. So you're picking up 100 basis points over the market, and I don't think the default potential for this particular company is any different than the market. And they also have subordinated debt that's actually subordinated to the senior ones they're trading at 10 3/4% yield. That's a lot more risky. I think you have to be more careful, and you'd have a much smaller position in that. But that's also something for, the right person and the right allocation that I think is attractive.
Gentlemen, I think we're going to leave it there. Thank you all for joining us today.
Thank
you. That's been Barry Allen, President and Chief Investing Officer at Mayer Asset Management, Jean-François Tardif, President and Portfolio Manager at Timolo Investment Management, and Frank Mayer, Chairman and Co-Portfolio Manager at Vision Capital Corporation. That is it for Headline. If you missed any of today's show, you can watch it online at bnn.ca, or you can catch it on the repeat at 10 p.m. Eastern, 7 p.m. Pacific. And if you have comments or suggestions, send us an email, headline@bnn.ca, or tweet me at TonyKeller1. Thanks for watching.